The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Small Business Tuesday continues with Your Money, Your Call.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open on 1300 30 34 35, or if you prefer, you can also email us on yourmoney@skynews.com.au. And joining me in the studio tonight, we have John Gajewski from APTA. Well, we're right in the middle of earnings season and there's certainly a lot to digest. There's been some big moves today on the market and no doubt a lot of questions on what stocks are going to outperform and which stocks may underperform. Let's start off by asking John, what he thinks of the market at the moment? Because John, just having a look at the market, it looks like it's been stuck in this trading range for the Australian share market, at least for the last 12 weeks. And it seems like just above 5,800 points is a real resistance level for the market. What do you think of the market at the moment?
Well, a couple of weeks ago we had a good sharp drop, and it's been followed by this very congested ranging. So that's signalling that the movement down that started a few weeks ago has still got a little bit further to go. Probably for the next several days, maybe even a couple of weeks, I still see there's chance that we'll continue testing the top side, but the gains will be very small, and I think the danger is that we'll start seeing the market break lower.
Okay, so watching to see some of those technicals on the market. Let's kick off with an email. We have an email here from Peter who asks, what are your thoughts on Charter Hall, Super Retail Group and Sydney Airports for a super fund? So 3 different stocks. Let's start off by having a look at Charter Hall. Of course, the Real Estate Investment Trust has been a great performer since the global financial crisis, but recently has been under a little bit of pressure. Looking at Charter Hall, and of course the chatter is at the moment that it is looking at Hastings and perhaps taking that over from Westpac. And what it means is that Charter Hall is in a good capital position. So this earnings season, just watching to see that capital backdrop and what it may mean for some of those unit holders, but expecting a company like this to outperform. John, having a look at the technicals for this one, what do you think? And we'll try and get a chart up for CHC.
Well, it's been a good performer for several years, but the gains it's been making in each swing have been fairly small. And with the latest swing up, we had a high in the middle of 2016 and then another equal high just a couple of months ago, and the market's moved back fairly firmly off that. So that looks like there's more room to the downside. Head back to that swing low we had around about $4.30 back at the end of 2016. So certainly at this point in time there's scope there for a swing back up, but I think $5.50 will be about as much as we can expect on this occasion, and then look for lower levels. And provided that in a couple of months' time we're bouncing up $4.30, then we may be able to continue the trend that we've had for the last 7 or 8 years.
Okay, so I guess being in that REIT space, also just watching that distribution, because sometimes it is all about yield, especially here in Australia where interest rates probably aren't going to move quickly anytime soon. Now the next company was Super Retail Group, SUL is the stock code there. Recently there has been an announcement that it will be looking at closing its Amart brands and instead focusing in on Rebel Sport. But we know just how hard retail is, with some of the most shorted stocks on the Australian market being retail stocks. Myer 16.5%, and in the top shorted stocks on the Aussie share market with more than 10% of stock being shorted are stocks like Harvey Norman, Retail Food Group, as well as JB Hi-Fi. So let's have a look at Super Retail Group. SUL's the stock code. I'm going to go to John for a technical view on this one.
Yeah, this one's really started to move into a secondary downtrend. It's was pretty well supported for about two and a half years, from about the middle of 2014. And we saw a couple of attempts to get above $11, but in the last 3 months it moved away from that quite sharply, snapped through the previous low of $8 and just holding around that point. Now, for the next 2 to 3 months, it may continue holding the $7.50, $8.50 range, but I think that's only buying time before it then moves down towards $6.
Okay, and the last stock there was Sydney Airport's SYD, the stock code there. Of course, once again, a high-yielding stock and moving around with expectations around interest rates. Having a look at a technical view on SYD, John, and what do you think of this one?
Interesting, yes. We had that high in 2016 around $7.50, and we briefly went above it a couple of months ago and immediately turned back down, and that's a clear sign there that the attempt to push it, take that trend, extend it into new highs was not well founded, and now likely to come back and retest the last low point we had, which is around about $5.80 back at the beginning of the year. So again, downside for the next few months, and reasonably good prospects that will hold that and then try to continue this uptrend it's been in for 8 years and continue a little high.
And I guess just having a look at Sydney Airports, I mean, there's a downtrend in place on the daily charts, but having a look at the weekly charts, and of course, if we do see that $6 mark coming under pressure, potential double tops there from what's been a very long trend, John. What do you think?
Yeah, absolutely. Is it a double top or is it a long-term consolidation? That's where the fun is, I think. Certainly at this stage, there's any movement down now will take a lot of the momentum readings to strongly oversold areas. So there's a very good chance that it will hold these long-term supporting areas between that $5 and $5.80 mark. So at this stage, I would say I would certainly look to the downside fairly quickly over the next 3 months or so. But then I'll give this trend a chance and let's see how it performs there.
Okay, so just summarising, Chater Hall, you say that it doesn't do too much, so probably just trending sideways. You don't like Sydney Airports because, potentially under pressure, and Super Retail Group. That was...
Yeah, that's also a clearly to the downside, excepting just for the next 2 months or so, where it might just hold water within about 50 cents a dollar of the current range before it heads lower.
Okay, and I like Charter Hall for a super fund, the yield of course being attractive there, and look, I think this is one that might outperform this earnings season. Retail I think is a much harder proposition at the moment, but I guess the big question is whether the market has overreacted from the entry of Amazon into Australia and whether we could see some reversals, but I'd probably wait off and hold off until we see a bit more confidence coming into that sector. And Sydney Airports I think is an interesting one. There's that whole question of that second airport over here in New South Wales, and I guess initially you could think that that could be a bad thing because it might take away some of the business from Sydney Airports, but if you have a look at the London example, what's happened is that the main airport has had some of the more premium higher margin flights coming in, and some of the cheaper lower margin flights have gone into further out airports. So we may see that type of thing with Sydney Airports, but of course it's really about what's going to happen in terms of bond yields and expectations around interest rates, and that's probably why I'd be a little bit cautious on Sydney Airport. So I'd probably prefer Charter Hall out of those three for a super fund. We do have our first caller on the line, so let's go straight to Roger from Melbourne. Roger, welcome to the show. How can we help you out tonight?
Thanks for taking my call, Julia. I would like to start with one of them. This IWF, which announced the results today. It opened about 6% and it's holding very well. It's already gone up 6%. Is it worth buying it at this stage? Is there any upside? What is the situation in this particular case? That's one thing. The second one is Rio Tinto, and what kind of technical is available for information is available? Is it a buy or what kind of upside is there? And also some comments on in general about the resource sector, please. Thank you.
Sure. So let's start off with IWF, which did come in with its result today, and what a stunning performance in terms of the stock price. We saw the stock up by more than 5% on the market. Look, we did see net profit actually down for this stock, but beating expectation, and the distribution was slightly higher than expected. And look, this is a company that's been a beneficiary of strong superannuation flows as well, and will continue to be a beneficiary. And I do like companies that do tend to outperform. Usually, if you do see that positive share price performance during earnings season, this tends to have a bit of an effect in months after earnings season has passed as well. And that's, to me, is why earnings season is so important, because you get an idea of which companies are growing and outperforming and which companies may be underperforming and might continue to underperform. So IOOF, certainly an outperformer on the market and a beneficiary of those superannuation flows, which I think are likely to continue. John, what do you think of IOOF?
IOOF's done some very good work over the last year and a half. We had a high around $11 back at the middle of 2015. The market came back to just under $8, and it's bounced off that level about 4 times. Kept to a small range, and then about 3 months ago, it started pushing upwards above that year-long range, and today has just been following through on that. So this is, has demonstrated that it's likes holding its long-term support. It's now picking up some very good momentum, coming off good levels. There's every reason to be optimistic on this one. It's still just got the 2015 high and its 2007 high, which is around about $12 to get over. And once we get through that level, then there's a chance of some good persistent gains for a little while. The only word of caution, of course, is that this it has been in a trend since 2009. So we are perhaps looking at the this is now the 3rd swing up. So just a little bit of caution that sort of in the next sort of 3 to 12 month range could be good gains, but after that, just caution once again.
And I guess just having a look at those charts, and the $11 mark is a significant one, and it's an area where we're pretty close to at the moment. And if we smash through that, the stock will be reaching the highest levels that we've seen in at least the last 5 years, and almost an all-time high, possibly challenging that peak that we saw back in 2007 as well. So interesting times for IOOF. That peak that you are seeing now getting close to testing some of those previous highs that we've seen for the stock. Rio Tinto now, an interesting one. We did see the $1 billion worth of capital management being announced when it came out with its results, but that wasn't enough to spur on the market. However, the key thing is that iron ore prices continue to defy expectations, trading at about 76. China certainly driving a lot of that, talking about not allowing scrap steel and holding back some of their steel production as well. And that's been great news for iron ore prices, as well as steel prices. The charts, John, I think they're looking pretty good here. What do you think? Yeah,
I like this one. I think it did some good work late last year when it moved up through $55. We did see a peak close to $70 at the start of this year, and the market's just essentially just been ranging, and to seeing it start to move up towards the top end of its range now is a good sign. It has held some support, so some long-term support. So it is in a good position to try to break through that high it had at $69.80. So I'm hopeful on that one. The move up hasn't been as good as, say, as we saw in IOOF, but it's still hopeful, and when we clear $70, then starting to push back to that 2011 high around $85 looks a good proposition.
Roger, this is really rare where you see panellists agreeing on both stocks. So IOOF and Rio Tinto looking pretty good at the moment, and certainly the share price performances over the last few weeks haven't been too shabby either. Let's now go to this email from Andrew, who asks, Santos has rallied 20% in a month. Should I sell now? It's been a good short-term trade, but I know short interest remains high and looks like minimal covering as yet. I mean, oil is such an interesting one, especially given that we're getting pretty close to Saudi Arabia, looking at the world's largest IPO of Aramco, which of course is the oil company there. Santos, you know, it's done extremely well from around about that $3 mark in July to be trading at about just under that $3.50 mark. Is it a sell for you, John?
The longer term picture on this one is very interesting because we had the peak in about 2008 and the market and a secondary peak around $13.50, and the market's essentially been on the downside since then. But in the last about the last year or so, we've had the market holding up above that low. The recent action is showing a market respecting the low it made back in early 2016. It's starting to show some interesting upside momentum here now. So nothing spectacular like in the other stocks we've seen already this evening, but a lift back up towards the $5.50 mark over the next several months is a reasonable proposition for this one.
Okay, so Santos looking pretty good there. Of course, oil prices pretty much have been range bound this year between about 45 to 55 US a barrel, but Santos looks like the chart's looking much better than they have in a very long time. They didn't seem to do much right last year, but it looks like oil prices helping the picture at the moment, and the chart's not looking too bad either. Let's go to a phone call now. We've got David on the line from Queensland. David, welcome to the show. How can we help you out?
Thank you very much.
Excuse me.
Just want to ask a question to your panellist about not a stock particular, but any small cap or mid cap stocks that are ASX listed. If they decide to dual list on the NASDAQ, what effects does that have to current shareholders that are on the ASX listed side of it as far as dilution, etc., going on previous experiences from other companies that have done that?
Sure. So the question is regarding small cap stocks on the ASX, dual listing on the NASDAQ and the impact on Australian shareholders. And I guess it depends on if they're raising new funds, which they usually are, to list on the NASDAQ. But essentially, there is a higher cost of compliance and maintenance to have a dual listing in play, and sometimes it has been the kiss of death for some of these smaller companies as well. So really you want to be sure on the fundamentals of the company and that the demand coming through from US shareholders is going to be sufficient to help to support the share price, and that has not always been the case in terms of some of these smaller cap holdings. John, any thoughts on this question?
No, not really. It's just still comes back down to supply and demand. It's now spread over two exchanges and one. The price action shows very little difference. There might be some volatile action when it lists, but beyond that it should then settle down and look no different to any other stock.
We'll be back with more after this short break. If you'd like to speak with our expert panel, which is just me and John tonight, it's 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to Your Money, Your Call. We are still taking your calls on 1300 30 34 35 and your emails on yourmoney@skynews.com.au. And we now have Wes from Ballarat on the line. Wes, welcome to the show. How can we help you tonight?
I've rang up before regarding a company called CM8, which is Crowd Mobile. And just recently they had a report out that's doing some pretty good numbers. And I'm just wondering, at a share prices around the 19-20 cents, whether you guys think it's a bit undervalued still. I think it's a $45 million turnover for the 12 months and a EBITDA of about $11 million. Just wondering what your thoughts are.
So having a look at Crowd Mobile, it is a smaller company. It's only got a market capitalisation of $42 million. I remember this one from a few years back. I think it was a backdoor listing from around about 2015, and this is where they crowdsource questions and answers. So you can ask questions like, what's the best laptop to buy, and they'll text you through the answers. So I think they operate in more than 10 different countries, so it's not just Australia-based, but it does trade over here. And from memory, the IPO price was 20 cents, and I think it's just trading at below that. We did see a quarterly update from the company recently, so revenue $11.6 million, underlying EBITDA of $3.3 million, and net debt of $2.7 million. So things not looking too bad. And certainly, John, that chart doesn't look too bad in 2017. I guess the big question is it peaking or can it continue there?
No, it's a good structure for a continuation. We did have a low of around 8 cents back in the end of 2016, having come down from around about 36 cents. So here at 19 cents, it's made some good gains from 8 cents. The structure's still very positive. It's still looking to expand upwards. So maybe some minor weakness towards 18 cents, 17 cents over the next month or so. But I'd be looking for this one to push for higher again and look for a return to that 36 cents.
Okay, so good to see some momentum in terms of its business, and if that can continue, certainly bodes well for the share price. And of course, that momentum from that last quarterly update, fourth quarter revenue, supporting a strong full-year earnings result should help to support the share price as well. It is now time for an email. We've got one here from Ransom who asks, may I have the panel's view on Domino's and Oil Search, please? Is it worth buying a few now and adding on further weakness? I mean, Domino's is such an interesting one, often seen as a technology play just as much as a food play, but certainly we've seen a volatile ride for its share price. So, John, I guess just having a look at the chart for Domino's, what do you think of it at the moment?
Oh, this is its long-term structures. Yeah, it's been very interesting indeed. You know, we're looking at under $10 6 years ago, hitting $80, now back at $53. Yes, we've had a sort of like accelerated trend towards that $80, and at this stage, just as a sharp fall away from that. So. Yeah, there's a risk here that we may see continuing period on the downside to the same extent we had it on the upside. For this to fall back to $40 or so, in terms of percentages against its previous trend, is still in the range of normal. What is a bit concerning more immediately, we did have a low point around $53, rallied back up to $65, has come down fairly sharply from that, and that's sort of signalling that it's ready to try that downside again. So looking for pushing down towards that $40 is not an unreasonable proposition at this stage.
I was going to say the same. I think it's going to get to at least $45 there in terms of Domino's. And I guess the thing here in Australia is that costs are going up. And so I think margins may have peaked for a company like this. And of course, when you are a model which needs to attract more franchisees, I guess to expand and grow the business, then you want to continue to see that growth coming through. And it is a company that has grown so well in the past. It hasn't been unusual to see growth rates of more than 20% for Domino's. But the question is, can they accelerate from here? Because they have been extremely bullish numbers over the last few years, and can they go the next level? And I think it's going to be a bit more difficult for Domino's to continue growing at the rates that they have been over the last few years. That was Domino's DMP, the stock price under pressure, and also some talk of a new menu there and some smaller pizzas, I guess, will help it in terms of margins. But the other stock was also Oil Search, OSH. It looks like some of those oil companies are popular tonight. So let's go to John and ask him about Oil Search. What do you think here?
Yeah, not too favoured, not too enamoured by this one. We've had a very good rally for the last quite a while, about from around 2002 low of under $1. We saw it peak just short of $10 back in 2014. We had this one sharp drop back down to $6. The market seems to be going sideways here. So whatever we're doing in the short to medium term, this stock will eventually go lower. Now, the clarity here, because of the ranging of the last 2 years, is not very good, and in the short run we're looking to test these low points it's had just under $6, but at this point in the trend there's a reasonable chance it may hold it and try to have a look at that $8 again over the coming year, but were we to slip through, say, that low point we had at $5.56, then it's definitely heading lower again and looking for the series of lows it had some 10 years ago around about the $3 mark. So, yeah, it's a bit of a two-way bet here. If we can hold $5.60 on the current swing down, we may get another short rally, but in long term, look lower.
Okay, so that was Domino's as well as Oil Search. It is time for our next caller. We have Jared on the line from Melbourne. Jared, welcome to the show. How can we help you out tonight?
Hi guys. I've just got a question for the panel in regards to Rectifier Technologies. They make rectifiers in the electrical industry, and they've got a bit of a relationship with Efosec and are looking to supply the electric vehicle industry, and in particular Efosec. And they've done some testing with BMW, but they are a really small cap company. And I just want to get the panel's opinion on them.
Okay, so looking at Rectifier Technologies, RFT is a stock code, and talking about small caps, it's only got a market capitalisation of $26 million. So it is on the small side, but having said that, just over the last few weeks, we have seen the shares gaining ground, mainly on, it looks like, an announcement about capacity expansion for the company. And I guess a company like this, what you want to see is that move upwards on a little bit of volume. So let's ask John what he thinks of in terms of the technical view for Rectifier Technologies, RFT being the stock code there. Look, John, we've seen a little bit of a move up in the month of August from around about that 13-cent 1.3 cent mark to that 2 cent mark, which is pretty substantial for a company this size. Is it on any sort of volume? What do you think of the technicals?
It's trying to do something. It's been very quiet since 2003, and then, was it last year? Middle of last year, we had this sudden move from about 1 cent up to 6 cents, and the market's been drifting back off that high. But it is still holding above that 1.5 cent level, which is still keeping it above its lows that it's had over the previous 10 years. So yeah, there is a reasonable chance here that this stock is trying to do something. It's had its first swing up to that 6 cents. The market's cooling off. Its action on the downside does fit something that's correcting rather than resuming a decline. Yes, we could still see it push back down to 1 cent over the 1 to 3 month time frame, but beyond that, I would be suspecting some upside action, and being such a small stock, it's likely to move. When it does move, it'll probably move almost instantaneously. So you'll need to. There won't be. That move won't give you much of a signal to get in on it. So volatility, yes, will be there. How high? It's really hard to gauge. The last significant level was somewhere around 15 cents. So yeah, it's in the ballpark for that sort of move.
Okay, so and if you're wondering what this company does, obviously rectifiers, but battery charging and converter business. So I guess you want to see a bit more growth coming through because it does trade on a fairly high PE ratio, but certainly interesting on the charts there. We do need to take a short break, but if you'd like to speak with our expert panel, please give us a call on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the program. Joining me in the studio tonight, we have John Gajewski from APTA. And if you have a question you'd like answered, please give us a call on 1300 30 34 35, or of course you can email us yourmoney@skynews.com.au. And we now have an email here from Brett, who asked, I have 1,000 shares in Suncorp. Do you recommend buying more ahead of the upcoming dividend? So having a look at Suncorp, and I guess this was one of the disappointing earnings results coming through in the August reporting season so far. Not only did the result disappoint market expectations, but they announced that they'd be spending $140 million into their strategy. And of course, that's going to eat into their results in the current financial year. So unfortunately, the market not too happy with the results. So I'd be steering away from this one, given that the market does expect it to be a more difficult year than anticipated in the current financial year. I mean, John, we've seen a substantial drop in the share price. Do you see this as a buying opportunity?
Oh, no, there's more to come, I think. What we experienced the last couple of months is a topside failure. The July high just pipped the highs of 2014 just by a couple of cents. Couldn't get on with it. Markets come off quite firmly. What we're in here is a long-term range. The bottom of that is around $10. So over the next couple of years, I would be expecting this to drift back down to $10. So don't expect any upside from current levels. Use those to maybe lock in some profit in your long positions and delay extending holdings on it for a while.
Okay, so I guess that's a no from both John and myself for Suncorp Midway. Unfortunately, the share's coming under pressure there, and we are seeing it around about those $13.50 levels. John, what levels would you become interested in a company like Suncorp?
Yeah. I would actually, before I even consider this one, I would like to see some positive price action from its supporting levels. Now, we've got one at $10, there's another one at $11.50. So until it starts demonstrating that it's hit a low point and has shown some upside momentum to take prices away from those levels, I wouldn't be interested at all. I think the story here is to the downside. The last time we had a swing down, it started in the middle of 2014, did not finish till late 2015. So I think this is one to step away from.
Okay, so some strong words there from John. We now have a caller on the line, so let's go to Ryan from Armidale. Ryan, welcome to the show. How can we help you out tonight?
Yes, my inquiry is in relation to Cabcharge. I noticed that their financial position looks good. Their share price just seems to be going down, and I wonder whether or not their actual standing warrants the decrease in their share price, and whether or not, consider they might be a buy at this stage. Thank you.
Sure. A question coming through from Ryan around Cabcharge. Of course, this is a company that's been beset with some pretty bad problems over the last few years. First of all, I guess the service charge falling from what used to be around about 10% down to more the 5% rate now. And then, of course, Uber and the take-up there that we've seen here in Australia. If we have a look at Cabcharge, it, I guess, provides an alternative to cash for the taxis here in Australia. And it also owns taxis combined, as well as a taxi plate business as well. But wow, look at that chart. Certainly not a pretty looking chart. John, any signs of that downtrend abating?
No, there isn't. We actually got that rally finishing around $3.30 and coming off quite strongly is signalling another phase down, and we're most likely to extend through the low we've already had around $2.05. So yeah, you have to keep on looking to the downside. I guess the only bright side here is that Cabcharge has actually been in a decline since its peak in 2007. So there it peaked around $11. So you do get a sense here that perhaps we are coming in the final stages of the decline. But at this stage, there's no sign of that yet, and sit back from it.
And I guess that peak sort of in February coincided with that special dividend that they announced and that capital management, which was a nice surprise to the market. But since then, there's been no positive catalyst there, so unfortunately too much risk here, Ryan. I prefer companies that are seeing growth in terms of earnings and not structural challenges. And with Cabcharge, we have seen that change in technology with Uber coming on, really eating away at its core business. And of course, the payment systems as well. That's something that's been face competition. I often catch cabs, and when I'm in the cab I ask them about the machines, and usually they have two machines. They've got the CabCharge machine, and then they have a Suncorp Metway machine or another bank machine, or these days even through an app on their iPhone which they swipe. So there's more competition in that payments area, and of course with Uber as well, competition in terms of that taxi business as well, which is a little bit difficult. So I prefer to stay away from a company that has its core business under a challenge. We now have an email here from a viewer who asks, what are your thoughts on Sierra Resources? SYR is the stock code there. I think this is actually the second most shorted company on the Australian share market. We've seen a string of bad news coming through for this business. If we can bring up the share price, it's probably reflected in the share price there as well. So having a look at Sierra, John, and what do you make of this one?
Yeah, sharp drop from that 2016 high. It's already been back to the swing lows that preceded that high, around $2.50. The market's trying hard to hold that, but not doing a good job of it. The July action is clearly saying the upside has failed, so we're now looking to the downside again, and consequently looking for a drop through that recent low of $2.23. So more weakness to come.
And I guess the recent update from the company not instilling any confidence, and that's another delay to its Balma mine. So once again, confidence coming out of the stock price coming under a bit of pressure on the back of that latest update that we saw early in August. We are going to take a short break, but we'll be back to answer more of your questions in just a moment. If you'd like to speak with our panel, give us a call on 1300 30 34 35, or you can email us yourmoney@skynews.com.au. Welcome back to the show. If you have a question you'd like answered, our phone lines are open on 1300 30 34 35, or of course you can email us yourmoney@skynews.com.au. And we now have Tulsi on the line from New South Wales. Tulsi, welcome to the show. How can we help you out tonight?
Paperless money.
Hi.
Paperless money. I mean, they want to replace this money.
I think we might have lost Tulsi. Tulsi, do we have you on the line? I think you might be on a different phone call by the sounds of it. I'm just hearing that he was asking about Certex as well as BWX. So let's, I guess, start off with Certex. SRX is the code there. And look, the share price has been here, there and everywhere. We saw the CEO disappearing, and of course the possibility of a class action being successful there. SRX is a stock code. John, having a look at the treatments into liver cancer, what do you think here?
Oh, I like this one.
You like it?
Yeah, it's had a big decline from its $40 high back in 2015, but its recent drop to $11 and then immediately sprang back up again, I think is an early indicator that this long-term decline may well be over. So I think over the next year or two, you'll probably see some sort of ranging going along above $11, maybe up towards the $20, $23 mark for a while. But then beyond that range, it's got probably have good prospects to try the upside.
I mean, John, I love it when an Australian company is doing well, and Certex for a long time, it was doing so well, but of course its ambitions were more than just a salvage therapy in the area of liver cancer. It was hoping to be, a third place treatment, or, even up the chain there, but the Sarah as well as the Foxfire global trials, they failed to meet their primary endpoints. So really, I guess it's about the growth of their product in salvage therapy, which is still, I guess, quite strong. And as you mentioned, the share price bouncing back very nicely from some of the turmoil that was around in late 2016. BWX is an interesting one. It's one that hasn't been on the market for too long, but if you go into the healthcare shop, you'll see some of its brands around. And these are organic skincare brands, they're organic shampoos and conditioners. They're expanding into the UK as well as China. They are on a higher multiple because, of course, you are buying into that growth story and, of course, the risks of going offshore. However, look, I think this is an interesting growth story here. What do you think, John?
Well, yes, it's had a good expansion in price since its floating back in 2015. But we had one high just around about $5.60 back in the middle of 2015, and then a few months ago we went through that level but didn't sustain it. So once again we've got this topside failure happening. So I think the market's just coming into this pause area. How much of the downside? I mean, generally under these circumstances, I look for a move back to its last swing low, which is just under $4.
Wow.
It does have some good support levels around $4.90. And we're pretty close to that. So I'm suspecting that in the next month or so, we'll actually see $4.90 and bounce, and probably range $4.90, $5.40 or so for a little while before then swinging back down again to make that look at $4.
I mean, I have to agree with you. I was looking at the daily charts with BWX, which doesn't look too bad, but then when you have a look at the weeklies, it does look like a new downtrend may have just started there for BWX. So John's saying, look, we might see a test of that $4 mark, which is a pretty steep fall because it's trading above $5 at the moment. Let's now go to this email from David, who asks, can you tell me why Nick Scali shares were up today while other retailers such as Harvey Norman and JB Hi-Fi were down? I get looking at some of those retailers. I have to say, Nick Scali is probably in a good place this earnings season compared to Harvey Norman and JB Hi-Fi. Look, all three of them are probably going to feel what's called the wealth effect from rising property markets in key areas like Sydney and Melbourne. But Nick Scali has seen greater growth rates and, of course, greater leverage to that housing story. So I guess if you are backing that property run over here in Sydney and over in Melbourne is going to continue on further, then Nick Scali would be the stock that would outperform compared to the likes of JB Hi-Fi as well as Harvey Norman. Having said that though, lots of shorts in this one. In this area, especially in terms of JB Hi-Fi and Harvey Norman, both of these companies having more than 10% of their stocks shorted. So it's going to be interesting because it's not going to take much to see a big pop in the share price if we do see either of these companies outperforming expectations. So earnings season certainly going to be an important one for the retailers. I mean, just having a look at the charts, I have to say Nick Scali is looking quite interesting from a shorter term perspective here. What do you think, John?
I look at this chart and think Domino's Pizza.
Wow.
Yeah, it's had a fantastic rise. 3 years ago we were around $2.50, $3. We've peaked at $7.50. It's come down very strongly. It hasn't broken any major levels, but the bounce we've had off the low of $5.65 seen in June is got that bounce feel, and that suggests that we may go a few points on, maybe as high as $7, but looking to move back down towards that $4.70 zone. Look, given where it's come from, that's still in percentage terms, still in the realms of normal percentage retracements. Given that its sharp rally over previous years does distort the feel about it, but in percentage terms, it's sort of like a normal sort of movement.
And what about Harvey Norman and JB Hi-Fi? Obviously, these stocks have been under pressure over the last 52 weeks on fears around Amazon and the retailing space. But coming into reporting season, we've seen a bit of a bounce back in terms of the shares. Harvey Norman moving upwards and JB Hi-Fi moving from below $22 to around the $26 mark. Just having a look at Harvey Norman, we've seen the same type of move from around about $3.60 to about $4.40. What do you think here, John?
Yeah.
Maybe just a bit of short covering coming into
yeah,
this
look, the action over the last 3 months, the action on Harvey Norman has been very good. The month the low was made, the range contracted and closed near the high of the month, and that was the first sign that this decline down from $5.50 was coming to an end. And then in July we had a good expanding range, so that again is very favourable. It only stayed below its 2015 swing low for less than a month, which is a fairly good sign that this market will try to resume this rally it's been in since those 2012 lows. Put that in a longer perspective, the high was in 2007. Essentially, the low point came in 2008, and since then it's just been this long-term range between these lows around $1.80 and the recent high at $5.50. That in itself is saying in the long-term structure, do be wary of the upside. That said, if this good rise up is quite surprising, and it is favourable to try to make another high, but I have my suspicions on it now. I think that we may, if we do get above last year's high, we won't see it up there for too long. So yeah, this is a favourable one to, I think, a good one to buy. Use any dips to buy and see it run into another high.
Let's try and squeeze in a final email from Min, who asks, panel's thoughts on Galaxy Resources and BlueScope Steel, please. Let's start off with Galaxy Resources, looking at that lithium area. And look, we have seen consolidation of Galaxy's shares, and that initially led to a bit of a bump in terms of share price action. But you know, we always see the shares moving upwards. It's only one of two producers of lithium on the Aussie share market, the other one being Orocobre, which of course has been beset with production problems. So having a look at GXY, John, what's your thoughts on this lithium company?
Yeah, it's had some weakness over this course of this year, falling from that $3.50 down to $1.50. But an interesting rise again. It started rising just above its 2016 swing low, which does point to some upside over the rest of this year. Not sure whether it'll be able to push up into to extend its rally, but getting close to $3 looks a reasonable proposition.
Okay. And of course, we've got less than a minute left now. So BlueScope Steel, this chart is an amazing looking chart. And look, the outlook from the US still looking pretty good. The infrastructure spend there and the expansion that we'll probably see means that even though we've seen such a great looking chart, I think it has the capacity to go further upwards. What do you think, John? Do you think it's peaking yet?
Yeah, the story here is, the peak in 2007, decline didn't finish to 2012, and now we're having this steady rise out of those lows. We had one wave up to a high of in 2014, corrected back to the middle of 2015, and a good, steady, well-structured a rise from that 2015 low. And with that sort of structure, it's well supported. It does have a high probability of continuing on. We haven't seen any sharp rise in the price in this sequence yet, and given the sort of higher levels it was earlier on, yeah, there is scope that we might get surprised on the upside at some stage.
That's all we have time for today. Thanks so much to our guests tonight. You could have called it the John Gajewski Show from APTA, and given that you are the only panellist tonight, do you want to tell us a little bit about APTA?
Oh, the Australian Professional Technical Analysts Association. We are a group of technical analysts who work in the markets, either with institutions or independently as advisors or as private traders and fund managers. And we just get together and talk charts.
And of course, if you missed any of the show, want to listen again or catch up on any of the program, go to your favourite podcast platform and search for Sky News, Your Money, Your Call. Until next week, I'm Julia Lee from Bell Direct. Thanks for your company.
Good night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.